Welcome back to the Deep Dive. Today, we are cutting right through the noise.
Yeah, we're skipping the prepared statements entirely.
And jumping straight into the cross-examination, the Q&A session from the Q1 fiscal 2026 earnings call for a certain global athletic giant.
That's right. Our mission here is pretty surgical. We want to extract what the top financial analysts were really focused on.
Because their questions tell the real story.
Exactly. They reveal the true operational pressure points and, the real progress markers for these huge turnaround plans they have, the win now actions, and the sport offense.
So we're going to cover the big financial headwinds, especially this escalating tariff situation. Then we'll look at the early operational wins, where the new strategy is actually working.
And finally, we have to get into the tough stuff, the strategic challenges that are still there in digital and critically in Greater China.
Okay, let's get into it. So let's start with what everyone was watching for.
Yeah.
The future demand signal.
Right. The spring order book.
Analyst Michael Benetti went right for this. In this, uncertain economy, what's the forward look on demand?
Well, the immediate signal is actually positive. The spring order book is up year over year.
Okay, but there's a catch, right? There's always a catch.
There's always a catch. The nuance is key here. That growth is really concentrated in North America, AMEA, and APLA.
So Europe, Middle East, Africa, Asia Pacific, Latin America.
Exactly. And that strength is what's offsetting the persistent headwinds they're feeling in Greater China.
So demand is stabilizing in most places, but the margin story, that was painful. Gross margin was down 320 basis points.
It was. And the CFO laid out three main reasons for the pressure in FY26.
What were the big culprits?
So in order, it was short-term product and channel mix issues, then the temporary costs from those win now actions, clearing out inventory.
Right.
And then the big one, new tariffs. And this is where the news got really, really expensive, very fast.
This is what the market was buzzing about. The tariff estimate revision. How bad is it?
It's a huge number. Just 90 days ago, they were guiding to an annual cost of about $1 billion.
$1 billion. Okay.
That estimate has jumped to approximately $1.5 billion annually.
Wow. $500 million revision.
Yeah.
In one quarter. I mean, how do they even account for missing the mark that badly?
Well, they're pointing mostly to external factors, specifically new reciprocal trade duties that, kicked in unexpectedly.
So it's out of their hands, is the argument.
That's the argument. But regardless of the cause, that increase means the net hit on their FY26 gross margin is now expected to be 120 basis points.
Up from 75. That's a massive headwind.
It's the single biggest factor weighing on their short-term outlook.
So given that enormous $1.5 billion anchor, how can they possibly stick to their long-term vision for margins?
They insist they are fully committed to returning to double-digit margins over time.
So the long-term goal hasn't changed?
Not at all. They see a clear path. Reignite organic growth, increase the full price mix of the business.
Which is why they're pulling back on digital promotions.
Exactly. And then drive operating leverage once that top line gets healthy again.
Okay, and one last piece on the financials. Inventory. John Kernan asked about this. Are they getting cleaner?
They are. And this is a really positive sign. Overall inventory dollars are down 2%.
Units.
Units are down even further in North America, AMEA, and Greater China. And this progress is key. It should lead to margin benefits in the second half of the year.
And it frees up their partners to buy new product.
That's the most important part. The wholesale partners open to buy is now freed up. It signals confidence that newness will actually sell.
All right, let's shift gears to the strategy itself. Matthew Boss wanted to know about the early wins from this sport offense idea. Where is it actually working on the ground?
The number one proof point they keep highlighting is running.
Running.
The running business grew, get this, over 20% this quarter.
20%. Okay, so that's the poster child for the new playbook.
It is. The success is tied directly to solving for three core runner needs: big cushioning, stability, and everyday energy return. They designed product for those needs, and it's working.
And geographically, North America is the best example of this working.
Yes, North America is where they're seeing the most integrated marketplace growth from this strategy.
So break down this sport offense idea. How is it fundamentally different from the old structure?
Well, the old way was organized mainly by gender, men's, women's, kids.
Right.
The new sport offense is aligned by brand and, crucially, by sport.
So you have a running team, a basketball team.
Exactly. They're smaller, cross-functional teams that are supposed to get sharper, faster insights from the athletes they're serving. Think of it less like one giant aircraft carrier and more like a fleet of smaller, faster speedboats.
And part of that means clearing the old stuff out of the way. They're managing the decline of older franchises.
Yeah, you have to. They're actively managing down inventory on huge franchises like the Air Jordan 1 and especially the Dunk.
The Dunk.
Yep.
And management was clear that the aggressive actions on the Dunk are going to be even more significant in Q2.
Which hurts the revenue comparison.
It's a painful but necessary move. You have to do it to reset the marketplace for profitable growth down the line.
Okay, now let's get into the areas where, progress is not a straight line. Brooke Roach asked the tough question about Nike Digital. If this is your premium channel, why is organic traffic falling off a cliff?
It is. Traffic is down double digits, but management insists this is a direct, deliberate choice.
A choice to have less traffic.
A choice to have more profitable traffic. They are repositioning the entire digital business as a full-price channel.
How?
They cut site-wide promotion days by over 50%. They lowered markdown rates. And crucially, they pulled back on paid media that was just driving that low-value bottom-of-the-funnel traffic.
So they're sacrificing volume for quality. The market has to be skeptical of that, though, right? It's the core question. They're trying to shift the whole narrative. And they were very clear. They do not expect Nike Direct to return to growth for the entire fiscal year.
Wow.
The goal is simply to make it a more profitable channel. And they're measuring its success, in part, by the fact that their wholesale partners are now seeing momentum.
Meaning they've stopped competing with their own partners.
That's the idea.
Okay, shifting to the other major headwind, Greater China. Lorraine Hutchinson focused on this. Revenue is down 10%. What's the plan there?
China is, it's a massive and very specific problem. The strategy there is to lead with sport basketball, running, training, football.
And localize the product.
Right, through what they call the Geo Express lane. It's local for local product. And they're connecting through local athlete activations, bringing guys like Ja and LeBron out to key markets.
What about the actual marketplace there? Digital and physical stores.
The digital marketplace is just hyper-promotional, much more so than other regions. In physical retail, they're testing some new mono-brand store concepts.
But it sounds slow.
It is very slow. Management stressed that China will continue to be a significant headwind on both the top line and on margin for the rest of fiscal year 26. The store pilots are encouraging, but not enough to justify a big investment yet.
All right, let's wrap up with a real-time check on the market. Pell Data asked if the consumer environment is dynamic and if there's any kind of pull forward in August that made Q1 look better than it was.
Management confirmed the environment is dynamic, which is, the word everyone uses.
The classic corporate buzzword for unpredictable.
Exactly. But importantly, they said their Q1 performance did not rely on a broad pull forward of demand. But they did note that the really strong North America wholesale growth, which was up 11%, was partly due to the timing of fall shipments compared to last year.
So some timing benefit, but not a consumer binge.
That's the takeaway.
And looking ahead to Q2, they're guiding for a low single-digit revenue decline. What's driving that?
It's really two things, and they both tie back to that long-term profit plan. First, Nike Digital is facing a much tougher comparison because they're now fully lapping the start of that promotion pullback from last year. And second, as we just discussed, Q2 is when we'll see the increased impact of them aggressively managing down the Dunk franchise. Short-term pain for long-term gain. So, the overall message here is that progress in this comeback it's just not linear. It's uneven.
Right.
You have real confidence and momentum where they've prioritized it in running in North America with their wholesale partners, but there's significant structural work still ahead in sportswear, Nike Direct, Greater China, and Converse.
The turnaround is happening, but the cost is steep and the clock is definitely ticking. So here's a final thought for you to mull over.
Let's hear it.
Given that confirmed $1.5 billion annual tariff burden and the commitment to get back to double-digit margins, how much do they now have to rely solely on the success of this new sport offense to drive enough profitable organic growth to outrun those massive macro pressures?
It really is a high-stakes race between global economics and their own brand execution.
That's it for this deep dive. We hope this gave you the shortcut you needed to be well informed on this quarter's key challenges and triumphs.